BPS higher at 3.5%. By Tyler Durden. Tuesday, March 19, 2024, 2:45 p.m. 2 years ago, we first said that it's only a matter of time before the Fed admits it is unable to resolve the so-called last mile of inflation, and that as a result, the old inflation target of 2% is no longer viable. Then 1 year ago, we correctly said that while everyone was paying attention elsewhere, the inflation target had already been hiked to 2.8%, on the way to even more increases. And while the Fed still pretends it can one day lower inflation to 2% even as it prepares to cut rates as soon as June, moments ago Goldman published a note from its economics team which had the balls to finally call a spade, and concluded that, as part of the Fed's next big debate, i.e., rethinking the neutral rate, both the neutral and terminal rate, a polite euphemism for the inflation target, are much higher than conventional wisdom believes, and that as a result Goldman is penciling in a terminal rate of 3.25 to 3.5% the cycle, 100 BP above the peak reached last cycle. There is more in the full Goldman note, but below we excerpt the key fragments. We argued last cycle that the long-run neutral rate was not as low as widely thought, perhaps closer to 3 to 3.5% in nominal terms than to 2 to 2.5%. We have also argued the cycle that the short-run neutral rate could be higher still because the fiscal deficit is much larger than usual. In fact, estimates of the elasticity of the neutral rate to the deficit suggest that the wider deficit might boost the short-term neutral rate by 1 to 1.5%. Fed economists have also offered another reason why the short-term neutral rate might be elevated, namely that broad financial conditions have not tightened commensurately with the rise in the funds rate, limiting transmission to the economy. Over the coming year, Fed officials are likely to debate whether the neutral rate is still as low as they assumed last cycle and as the dot plot implies. Translation. Raising the neutral rate estimate is also the first step to admitting that the traditional 2% inflation target is higher than previously expected. And once the Fed officially crosses that particular Rubicon, all bets are off. Their thinking is likely to be influenced by distant forward market rates, which have risen 1-2 pp since the pre-pandemic years to about 4%, by model-based estimates of neutral, whose earlier real-time values have been revised up by roughly 0.5 pp on average to about 3.5% nominal and whose latest values are little changed, and by their perception of how well the economy is performing at the current level of the funds rate. The bank's conclusion. We expect Fed officials to raise their estimates of neutral over time both by raising their long-run neutral rate somewhat and by concluding that short-run neutral is currently higher than long-run neutral. While we are fairly confident that Fed officials will not be comfortable leaving the funds rate above 5% indefinitely once inflation approaches 2%, and that they will not go all the way back to 2.5% purely in the name of normalization, we are quite uncertain about where in between they will ultimately land. Because the economy is not sensitive enough to small changes in the funds rate to make it glaringly obvious when neutral has been reached, the terminal or equilibrium rate where the FOMC decides to leave the funds rate is partly a matter of the true neutral rate and partly a matter of the perceived neutral rate. For now, we are penciling in a terminal rate of 3.25 to 3.5% the cycle, 100 BPS above the peak reached last cycle. This reflects both our view that neutral is higher than Fed officials think and our expectation that their thinking will evolve. Not that this should come as a surprise. As a reminder, with the U.S. now $35.5 trillion in debt and rising by $1 trillion every 100 days, we are fast approaching the Minsky moment, which means the U.S. has just a handful of options left: losing the reserve currency status, QEing the deficit and every new dollar in debt, or, the only viable alternative, inflating it all away. The only question we had before is when do serious economists make the same admission? They now have, and not just Goldman. Earlier today, Apollo's Torsten Slok admitted his latest, Daily Spark, chart that inflation is now sticky at 3%. The Fed's inflation target is 2%, and the bottom line of the inflation discussion is that inflation has started to move sideways at 3%, and this is a problem for the Fed. See chart below. And while we have discussed the staggering consequences of raising the inflation target by just 1% from 2% to 3% on everything from markets to economic growth, instead of doubling every 35 years at 2% inflation target, prices would double every 23 years at 3%, and social cohesion, we will soon rerun the analysis again as the implications are profound. For now, all you need to know is that with the US about to implicitly hit the overdrive of dollar devaluation, anything that is non-fiat will be much more preferable over fiat alternatives. Much more in the full Goldman note available to pro subs in the usual place. 62009354. More market stories on Zero Hedge. Bill Gates-backed company seeks to deploy small modular nuclear reactors in U.S. Boycott slams Planet Fitness shares as Americans fight back against wokeism. FOMC preview, 2 or 3 cuts in 2024, and what does taper look like? Show comments. Discrimination notice.